Good morning, everyone. Thank you for coming. It's Patriots Day. It's the day of the Boston Marathon, but it's also the day where we're very lucky to have Valdis Dombrovskis here with us at the Center for European Studies, and I want to thank my colleagues here at CES for hosting us this morning for what I believe is going to be a very interesting discussion and dialogue with Vice President Dombrovskis. Mr. Dombrovskis served as Latvia's Prime Minister between 2009 and 2014, which was a very difficult period in the country's history. After very fast economic growth, the Baltic Tigers, this was a period where the country was in deep crisis. You became Prime Minister, you had to make very hard decisions, and I think some of the decisions that Mr. Dombrovskis made were, initially at least, not supported by the IMF and the more orthodox view what you should do in these type of crises. Latvia decided to go for what was called at the time internal devaluation. So rather than abandoning at the time the ambition to become member of the Eurozone, there was a deep cut in a lot of wages. A lot of people were released from the public sector, and also the private sector contracted after what had been very much driven by capital inflows crisis that we saw. I think at the time, you then managed to do something which your new boss, the president of the European Commission at the time, said was impossible. Mr. Juncker said around that time that we all know what needs to be done, we just don't know how to be re-elected. You were re-elected in Latvia, which in itself was a bit of a surprise because this is a country that had changed prime ministers very often. So that was an interesting experience. In 2014, then you assumed your current position in the European Commission, and that again I think is a very interesting new chapter. The European Commission has been restructured internally, so we now have a structure with 5 vice presidents and also a first vice president. Mr. Dombrovskis is in charge of the Euro and the social dialogue, and if I understand correctly, your job is partly to coordinate what 7 other commissioners and their services are doing related to this field. So lots of issues to talk about, short-term with Greece, long-term where Europe is going, both in terms of economics, but also maybe in terms of how we structure political decision-making in Europe. Mr. Dombrovskis, we're looking forward to your comments. Thank you.
So, ladies and gentlemen, Dr. Ketels, it's a great pleasure for me to address you here today and to share some of the views of key economic challenges we're facing in Europe, and also to give some comparisons with the US. And it's an honor for me to be here in Harvard University during my first official visit as a Vice President for European Commission in the United States. And I would like to thank Center for European Studies and Dr. Christian Ketels of Harvard Business School for organizing this event and for this opportunity to address you. If we look at the current economic situation, we can have a little bit of relief. Things globally are on the up. Here in US, economy looks quite strong, so we expect economic growth above 3% this year. World's second biggest economy, China, is set to grow around some 7%. So how is Europe doing in this context? After a deep and double-dip recession, Europe is now also gradually recovering. This recovery started in 2013, and it's progressing. So growth in Euro area is expected at 1.3% this year and at 1.9% next year. Also, there are some positive developments in job creation and in a number of other areas. As regards unemployment in EU has finally fallen to the single digits, to 9.8% for the European Union of all 28 member states. but it still remains at double digits, 11.3% for the euro area countries, for the 19 euro area countries. But still, it is the lowest unemployment rate we had since May 2012, and employment is increasing both in EU 28 and in euro area. Inflation is very low. That's also a certain worry, but we see that it's mainly driven by external factors such as fall in oil prices. So we expect inflation to gradually return to normal. External factors such as drop in oil prices and global growth are also helping EU's economic recovery. But above all, to recover from the crisis as deep as we had seen, it's important that we ourselves take decisive action in terms of our economic policy. So if we look at the recent economic crisis, it certainly is the deepest crisis and actually has been a greatest test to our economic endurance since the Great Depression and World Wars. The bursting of the US subprime bubble in 2007 and the fateful collapse of Lehman Brothers a year later led to the fully fledged financial and economical crisis. And when the crisis struck, it painfully exposed already existing weaknesses in Europe. Weaknesses were present in many European countries. Some saw fragilities in their financial sectors. Some others had toxic combinations with very high public and private debt levels, bursting real estate bubbles, and weak balances of payments. An additional factor was EU being very open to the world. About a quarter of euro area's GDP comes from exports of goods and services. It's twice as much as what US exports represents. But this, of course, leaves Europe more vulnerable when global trade slumps. The crisis also exposed weaknesses in the design of economic and monetary union. It was not equipped with necessary tools to properly tackle this kind of economic downturn. So what did Europe do? Since 1998, Europe has a common currency, the euro. And today, euro area has 19 member states, and it's set to expand further. But the economic and monetary union associated with the euro area did not have an effective framework in place to monitor and to correct economic imbalances quickly. So during the crisis, we had to tackle economic imbalances in different member states on ad hoc basis. We had to create from scratch some economic policy making structures that you in the US are taking for granted. But we had already taken a number of decisive steps, and there are more to come. And certainly now Europe is much better to address future challenges than it was before the previous crisis. So first, Europe has come a long way in reinforcing the economic policy coordination. The already existing fiscal surveillance structures have been substantially strengthened, and the scope of surveillance was widened also to include monitoring of macroeconomic imbalances. We now have an annual fiscal and macroeconomic governance mechanism called the European semester. Fiscal and macroeconomic policies in EU member states are closely monitored. Recommendations are issued to correct identified imbalances. In case of non-compliance, EU member states may be subjected to sanctions. Second, entirely new financial backstops have been created. These include the European Stability Mechanism, which is a powerful firewall providing loans to euro area countries in balance of payments difficulties. Third, we have created banking union. Financial sector regulations had become significantly stricter with higher liquidity and capital adequacy requirements. Banks have been subjected to rigorous stress tests and asset quality reviews. We now have a single European banking supervisor and a European bank resolution mechanism. Banking union has bail-in as a main principle of bank resolution, which then reduces the risks of European taxpayers to foot the bill when banks make mistakes. And it helps to create a stronger banking sector that can increase lending to the economy. Between 2008 and the start of the banking union in October 2014, Europe's 120 largest banking groups raised capital in excess of 250 billion euros. Fourth, the European Central Bank responded decisively in the financial crisis. Since its creation in 1999, the ECB has worked as a joint European monetary policy maker. It has been implementing monetary policy oriented primarily at price stability. It is defined as inflation below but close to 2%, while at the same time it supports the EU objectives to promote growth and reduce unemployment. Until the financial crisis, the ECB pursued this objective successfully by means of traditional monetary policy instruments. Since the start of the crisis, the ECB has gradually expanded its activities, and as the Fed and other central banks around the world have done. It carried out a broad set of non-conventional asset purchases, including sovereign debt, securitizations, and covered bonds, and additional lending programs. As a result, it managed to lift Europe out of very low inflation early on in the crisis in 2009. It also took decisive action to ensure financial conditions in different euro area countries do not diverge so much as to threaten the effectiveness of the single monetary policy. And it took an even bolder step to purchase much more significant quantities of sovereign debt on secondary markets when inflation expectations were unacceptably low again earlier this year. If you compare the size of the balance sheet of the Fed and ECB, it is striking that trends were quite similar. We saw roughly a doubling of pre-crisis balance sheets by 2008-2009 and a tripling by 2012-2013. After a temporary reduction, the ECB is now working towards these levels again, mainly through sovereign bond purchases to fight renewed very weak inflation in Europe. And we know that at the same time, discussion is taking place in US how to start monetary tightening. Of course, quantitative easing in the EU today works differently than it did some years ago in the US. In the EU, capital markets are less developed than in the US, and also today markets are actually full of liquidity. One key effect of ECB sovereign bond purchases will be to incentivize investors to replace their sovereign bond portfolios with other investments. This should in turn improve financing conditions in the economy. I would also add that US quantitative easing was a part of the broader trend, while we expect today monetary tightening outside the Europe. So we are slightly behind this global cycle of monetary policy. So Europe's recovery has not been easy, and it's still fragile. What we need to do now is actually to cement this recovery, and the strength of Europe's recovery will depend on our member states putting in place a common growth strategy. Growth, sorry, I apologize for my voice. It's air conditioning in Washington, D.C. A growth strategy which is based on three main priorities: investment, structural reforms, and fiscal responsibility. Now I will elaborate on those three priorities while highlighting the differences between EU and US economies. First, investment in Europe did not recover as fast as in the US. The level of investment in Europe is still substantially below its longer-term sustainable level of around 20 to 21% of GDP. Here in US, companies are regularly financed by corporate bonds or equity. European companies rely heavily on bank financing, and this difference proved critical during the banking crisis. Furthermore, US businesses entered the crisis with far lower corporate debt levels than their European counterparts. Investment rebounded as early as in 2011, when US economy started to pick up again. Also in the US, debt repayment by the average US business or household was made more rapidly than in Europe. This smoother deleveraging meant credit continued to flow in the US economy. Household consumption was also huge, has a substantial impact on growth, so US economy gained a certain tailwind here. So to deal with this still lagging back investment, European Commission launched an ambitious initiative, the EU Investment Plan. The aim of the plan is to mobilize 315 billion euros of both public and private investment over the next 3 years. The European Fund for Strategic Investments will support projects in areas such as infrastructure, research, and innovation. Substantial part of the plan will be directed to support lending for small and medium enterprises. We are now working also to diversify sources of financing for the real economy. In addition to bank lending, we should work to provide financing from capital markets. So the banking union will be complemented by capital markets union, a single market for capital for 28 member states. This will help to create the conditions that are necessary to strengthen the role of capital markets in order to finance the real economy. Boosting investment alone, however, will not be enough. It will only result in jobs and growth if we combine it with structural reforms to strengthen the competitiveness of the EU economy. This leads me to the second priority. The European Commission has a renewed focus on structural reforms, both at EU and national level. At EU level, it's about strengthening the EU internal market, especially in areas like services, energy, and digital market. It also means better regulation, doing at the EU level things with a clear European value added. But the main responsibility for structural reforms lies with member states. And member states levels, there are country-specific reform agendas which European Commission is coordinating. There are some common problematic areas in many member states. For example, labor markets. In the US, the labor market is both more flexible and mobile. In the EU, labor markets need to be more dynamic and open to new technologies and working methods. In many countries, we need to address the problem of segmented labor market with strongly protected jobs for some and very weak protection for others, mainly newcomers to the labor market. The result is very high youth unemployment in several EU member states. Youth unemployment is now one of the most pressing social problems today, and in the EU we have already created programs such as Youth Employment Initiative to provide employment or training for young people. As regards structural reforms, especially labor market reforms, social partners, employers and employees also have an important role to play. They are well placed to ensure the right balance between economic opportunities and good employment conditions. Other examples of structural reforms at member states level include improving the business environment, ensuring the long-term sustainability of social systems, taking into account the aging population, shifting the tax burden away from labor, especially low-paid labor, to other tax bases which are less detrimental to growth. These reforms adopted to the national context are essential if all EU member states are to grow again. Business-friendly environment, well-functioning markets, and cutting red tape are best preconditions for investment to rebound. As you know from the US experience, market integration between states can contribute a great deal to improving market functioning and creating new opportunities. As I already underlined, at European level, we're committed to reinforcing the single market and improving regulation. We are integrating our energy policy into energy union and building digital single market. In many ways, energy union has been there from the start of the European project. But both climate change and recent geopolitical events have given a new urgency to further integration and innovation in the area of energy. We also want to open up opportunities of the digital single market for citizens and businesses alike. The US turned to this path early on and has since been a world leader in the digital area. While with a digital single market, the EU can create additional growth up to 315 billion euros, create hundreds of thousands of new jobs, and a vibrant knowledge-based economy and society. We must ensure financial stability and moving to the third priority. So the third priority is fiscal responsibility. It's clear that we must ensure financial stability, and we should certainly avoid the repeat of recent sovereign debt crisis. While the heavy lifting in terms of EU fiscal consolidation is now behind us, high debt levels remain a drag on growth in many EU member states. There are still significant differences between EU countries. While Estonia has the lowest public debt level in the EU, just over 10% of the GDP, Greece has now reached 176%, and Italy is near 132%. Overall, in euro area, we expect a broadly neutral fiscal stance this year. What we need now are responsible and growth-friendly fiscal policies, prioritizing investment, prioritizing other areas which are facilitating economic growth. And we need to take into account different situations in different member states. Member states with excessive deficits should continue their adjustment and in order to actually return to the sustainable public finances, while those member states with available fiscal space should use it to stimulate investment and the consumption side of the economy. Tax systems need to be fairer, with tax fraud and evasion tackled decisively, while the tax burden of labor should be reduced. Reforms are already paying off in a number of EU countries. Those countries that followed the reform path, like my own country, Latvia, like other Baltic states, like Ireland, like Portugal, like Spain, are now actually among the fastest growing EU economies. Now, a little bit on the deepening of economic and monetary union. So what we need also to do are to take additional steps to raise Europe's growth potential. As I mentioned, the three priorities of investment, structural reforms, while maintaining fiscal responsibility. But it's also necessary to keep the economic and monetary union strong in the long run. We need a stronger, deeper economic and monetary union with a fully fledged common economic policy. By deepening the economic and monetary union, we can strengthen it to withstand future shocks. It is also the path to the real economic convergence. I already mentioned several elements which are already in place: strengthened fiscal and macroeconomic governance framework, financial backstops including ESM and the banking union. With an eye to the longer term, we need to forge a common understanding of what is missing in the institutional architecture for a stable and prosperous economic and monetary union after a recent major reinforcement. Our guiding principle of deeper integration is that any further risk sharing needs to go hand in hand with increased decision-making powers at European level. And this can be only achieved throughout a profound democratic process. So, ladies and gentlemen, it's clear to us in the EU that when we work together, taking concerted action, we are indeed greater than the sum of our parts. The same is true also for our transatlantic partnership. We both know that the pursuit of lasting economic growth and success takes us beyond our borders. In the global economy, if the global economy is to grow, then we, the world economic leaders, must grow together. In fact, the EU and US are already each other's biggest markets when it comes to the trade. The very volume of trade between us, over 720 billion euros a year, means that we can make big gains by tackling the remaining barriers of trade between us. The Transatlantic Trade and Investment Partnership, better known as TTIP, is therefore extremely important for both sides. These talks and a round of negotiations taking place in New York City right now are paving the way to a deal between the two largest and most advanced economies in the world. Striking this deal would help us to facilitate global recovery and growth together. In the current geopolitical context, we are committed to get a deal that opens markets for goods, services, and public procurement on both sides of the Atlantic. We want to improve our cooperation on regulatory issues. We hope the deal delivers results on non-tariff barriers for key sectors of our economy. It is important that we address the diversification of energy supply sources by ensuring access to US gas and crude oil. I mentioned the current geopolitical context. Indeed, in Europe, we see serious problems in both our southern and eastern neighborhoods. Turmoil in Middle East and Northern Africa, conflict in eastern Ukraine. The conflict in Ukraine is right on Europe's doorstep. It's having direct repercussions for us. So if Minsk agreements are not fully implemented by all parties, we could be facing a very real risk of further escalation and widening of the conflict. And Europe and US should not let this happen. This is where we, US and EU, should reinforce our joint resolve, both by building on our common values and demonstrating leadership. The EU and US should take a joint action to support Ukraine in its efforts to build a secure, stable, and economically developed country in the EU's neighborhood. Ladies and gentlemen, to conclude, I would like to reiterate my beliefs that we have much to gain and to learn from working together. Together with the US, Europe shares a vision of democracy, prosperity, and peace. Together, we can recover and to be stronger than before. Thank you for your attention.
Well, thank you so much, Vice President Dombrovskis. This was touching a lot of broad issues. I was really thankful for you to kind of lay out the current strategy of the Commission, but also putting it a little bit into context, how it compares to the United States and how it has evolved over the last few years. We called this event a dialogue with Vice President Dombrovskis. So I will start with a few questions, but then very quickly open it up to all of you and see what we can discuss. I know one topic that will come up is Greece. I will leave that for the discussion later on. But I wanted to probe some of the things that you said. I know that when you came into the Commission together with two other fellow prime ministers from the Baltic Sea region, Andris Ansip from Estonia and Jyrki Katainen from Finland, there was a little bit concern that there would be a very strong focus on the austerity part versus the investment part. You now laid out a much more balanced strategy. Is that a reflection that your thinking has changed, or that the environment has changed in which Europe and also Latvia finds itself?
Well, I would say it's rather the later. If we compare with the previous European Commission, previous European Commission had to work in circumstances of acute financial and economical crisis. And while in US, one can say that you only had the financial crisis and this burst of the real estate bubble, in Europe, on top of this, we also had a sovereign debt crisis, a confidence crisis. We had member states being locked away off from financial markets, unable to finance their budget deficits, or having to finance them at unreasonably high interest rates, which at the end of the day would not be sustainable anyway. So it was quite clear that at that time EU had to act to regain financial stability, to bring down budget deficits to the sustainable levels, to the levels where member states could regain market access. And that's why there was so much focus on fiscal adjustment. And there's also another aspect worth comparing, like in US, financial markets are happily financing your budget deficit at low interest rates, so there is, from that point of view, less sense of urgency. And what we saw that there is actually much less market tolerance, so to say, towards many EU countries, especially for smaller and peripheral countries. So from that point of view, certainly we had to be much more prudent. Well, now what we are facing a challenge of very slow recovery, very slow growth and job creation. So now we are really setting the also European Commission economic policy priorities to deal with this challenge. And that's why there is much emphasis on investment, that's why there is much emphasis on structural reforms to strengthen competitiveness, while still not forgetting about fiscal responsibility.
Thank you. I think very interesting that it's much less a question of ideology and much more an issue of diagnosing what the situation has been and finding the right answer. Now, you put investment as a very important element in the current phase of kind of getting the European economy back on track. I was stunned to hear that the European Investment Bank already now is giving more loans than all of the other international financial institutions, World Bank, all the regional investment banks, and so on. So there is a lot of capital in Europe. You also reported on the progress that has been made in terms of the banking union in Europe, but we still seem to find it quite hard to get European companies to invest more. What are the things that we should be looking out for? How is the Commission looking at these next steps? You've put some things in motion. What are the kind of milestones that you see ahead of you in terms of investment?
So the basic idea of the investment plan is to unlock substantially larger amounts of private investment while using relatively smaller amounts of public investment. So in this investment plan, we have 21 billion euros of public financing, which would provide then for 3 times higher lending capacity of European Fund for Strategic Investments, leading it to 63 billion euros. And we expect to attract 5 times higher level of the private investment, leading us to the 315 billion euros. And really, if you look at the reasons why there is not sufficient investment, It's not really the lack of liquidity of the markets, as I mentioned. Liquidity is there. It seems to be a very strong risk averseness of both borrowers and lenders. And so this plan tried to address this problem also by providing some kind of a first risk absorption capacities, some guarantees and other instruments actually to unlock this investment, which otherwise would not happen because of this very strong risk averseness. But of course, to attract private investment, it's important that this fund is professionally managed. So that's why from the Commission point of view, we put lots of emphasis that there is a professional management of the fund, that it's not influenced, so to say, politically. We are not putting country or sector quotas, so that really there is a possibility to evaluate projects based on their merit and based on their economic viability.
So that leads maybe a little bit into the second part of what you laid out, the three terms: investment, structural reform, and the fiscal sustainability. So on the structural reform, I must say I was reminded the first time that I had a chance to meet you was at the height of the Latvian crisis, and I think you were in the morning meeting with the IMF, and in the afternoon to try to kind of get a financing package together. And in the afternoon, you had a group of people to talk about long-term growth and what could be done to improve Latvia's competitiveness, which I thought was quite impressive, that there was both a short-term but as well as a long-term agenda. Now, you laid out for the European Commission the structural reform priorities that are there, and they all sound very intuitive. At the same time, it seems like this is also a set of issues that we've been chipping away in Europe at for quite some time. We had the Lisbon agenda, the relaunch of the Lisbon agenda, the Europe 2020 agenda. How is it going to be different this time? How are we going to make in Europe more progress on deepening the internal market, maybe creating a better environment for innovation, not only in those countries in Europe that are already doing quite well, but also in the rest of Europe?
Well, at the end of the day, of course, it will be down to the implementation, because clearly maybe the ideas which I mentioned are not necessarily new, but there are maybe also some differences. One is that we now really have this not only fiscal but also macroeconomic governance framework, that also member states' macroeconomic imbalances are being monitored, and European Commission issues country-specific recommendations to the member states of what needs to be done to address those imbalances, and then once again monitors the implementation of this. So it's now really an annual cycle with lots of monitoring and with lots of, if not pressures, then encouragement to member states actually to deliver those reforms. And also, if you remember, recently European Commission, well, not so recently anymore, in January, came with a communication on best use of flexibility within Stability and Growth Pact, where we concentrated also on things like investment clause and structural reform clause, basically linking possibilities to temporarily deviate from a member states' fiscal adjustment path, while if member states are doing the necessary structural reforms or investments. Those are, as always, how it was like rules and conditions apply to this.
Right.
If you, but the main idea is this. So there's both monitoring mechanism and also certain incentives if the member states wish to use them to actually speed up their structural reform effort.
So it seems it's a lot about the process on how to get things done rather than the debate on what are the priorities of those policies.
Well, of course, there are always debate about policy priorities.
Right.
And I mentioned also social partners, social dialogue.
Right.
Of course, we often hear very different views what the priorities should be. And it's not that those Commission priorities are not being criticized by various stakeholders.
Right.
But I would say, economically speaking, there is it's pretty much the mainstream view what needs to be done. From that point of view, there is less controversies, like economically speaking.
If you look in this process at the relationship between the Commission and the member countries, I mean, I looked recently at the review of the country-specific recommendations that are made within the European semester, and if I read the numbers correctly, it said 8% of those were substantial progress, about 40% some progress, 36% limited progress, 12% no progress. So it seems there's some traction with these recommendations in member countries, but there is also a high degree of things not happening. Do we have the right architecture in Europe in terms of how you and the Commission and the member countries kind of share responsibilities and collaborate in working through this program?
Well, we're now, of course, working on this. This is a relatively new architecture what we're having. This macroeconomics governance framework is new. There are so-called regulations which we are having. It's like what we call them six-pack and two-pack. Six-pack is there since 2011. Two-pack is there since 2013. So it's quite a new framework, and we are still, so to say, tweaking it, fine-tuning it, and trying to actually find ways how to improve also ownership of those country-specific recommendations. So it's not just saying that European Commission comes and gives some advice, and then you shelve it, but that it's actually discussed through with the member states, with also social partners in the member states, so that there is more understanding and ownership in the member states that those things actually need to be done. For example, this year we are adjusting the calendar of European semester exactly to allow for more discussions with member states and social partners in the member states.
So we talked a little bit about the macro structure, the macro strategy that you laid out. We talked about the structural reforms, talked a little bit about the architecture of how collaboration is happening. Just wanted to open it up to the audience. If you could quickly say your name so that Mr. Dombrovskis knows where you're coming from, please.
Tom Weber, and a visiting scholar here. Thank you for your talk and thoughts. I personally find very persuasive, but the sticking point is, of course, again, the implementation. And I would like to come back to that issue about the architecture and those recommendations. I mean, what makes you, I know this is something new, a new mechanism, but what makes you think that this will make a huge difference? I mean, it's not as if in the countries that need reform, there was no awareness. I mean, the main obstacle were systemic and political obstacles. So if we look at countries like France or Italy or Greece, it's not as if politicians there would have been stupid in the past, but that for systemic and political reasons, politicians felt that they were unable to implement those reforms. So what is different this time? What makes you believe that explaining to them why this is in the best interest will make a difference if they already understand on an intellectual basis that this would work anyway?
I mentioned that we have now this reinforced fiscal and macroeconomic governance framework. And of course, it has two elements in it. It's this fiscal part, which also quite clear enforcement mechanisms, but also this macroeconomic part has also some enforcement mechanisms via the excessive imbalances procedure. So for those member states which are found in excessive macroeconomic imbalances, there is a possibility to launch excessive imbalances procedure, which has actually similar monitoring structure as excessive deficit procedure. So far it has never been done, but certainly the possibility is there. So in extreme cases, if you see that member states are in extreme in excessive imbalances and not doing anything to actually address those imbalances, there are also some enforcement mechanisms. And as I said, there are also certain incentives actually by linking fiscal and structural reforms side. The very same structural reforms clause, which can provide some incentives for member states actually to speed up their structural reform effort. But I would say that this cycle of close annual monitoring, also of annual national reform programs, it seems to be delivering some results. Also in countries like France and Italy, you now hear much more discussion about structural reforms, and you actually see governments coming up with structural reform plans and actually implementing. So we really see that this new framework is helping to focus the minds, and that I think at the end of the day it will certainly help with moving forward the structural reforms agenda. Of course, at the end of the day, recommendations are recommendations. Yeah, those are not orders. So, but I think this framework is there, providing certain incentives and improving awareness of the need of those reforms. And we also, in implementation rates, we are actually seeing some progress.
So things are moving a little bit forward. Any other questions from the audience? Lady there in the back in the middle. No, that's you.
My name is Erica Vadis. I'm a senior here at Harvard studying government. And I wanted to ask you about your thoughts on interstate labor mobility and how that affects equality among EU states.
Okay, as regards labor mobility, as you know, EU has free movement of goods, services, capital, and labor. And this is one of the fundamental freedoms in the EU, and certainly this is something which the European Commission is very clearly enforcing, looking that there are no attempts to actually hamper the free movement. Of course, free movement of labor also comes with certain challenges. It comes with some accusations of social dumping, of abusing social welfare systems on one side. It comes with worries about brain drain and actually working age people population leaving in other countries. So it's certainly a very controversial discussion. And now also in European Commission we are taking several initiatives, such as targeted review of posting of workers directive, to look at some of the tensions, some of the imbalances which are being created. And while looking at this labor mobility, we are also looking at the effects, what it's having in terms of the brain drain or, for that sake, immigration levels. So really, there are some worries. So it's certainly good for individuals. So individuals certainly have more choice. They can go to whichever EU member state they want and then work. But in society in general, it's also creating some challenges which need to be looked at and to be mitigated.
So a difficult issue, especially in your home country that has
Exactly.
lost quite a share of its population. Please. Yes.
I'm Sebastian Royo. I'm a professor at Suffolk University here in Boston. The elephant in the room is Greece. It seems, based on most reports, that it will be a matter of weeks before they run out of funds to confront the payments. And there is a lot of speculation about what's going to happen, whether they will default. My question to you is what do you think will happen, and if Greece default, can it stay within the Eurozone?
Okay, so as regards situation in Greece, so I'll probably put it in a bit broader context, because if you look at the situation in Greece, the current crisis we are having was perfectly avoidable. If you look at Greece at the end of last year, Greece's economy was back to the economic growth. Very briefly, it was even among the fastest growing EU economies. Greece had quite a healthy job creation. Greece was delivering on its fiscal targets. Greece has restored financial stability. So what we were discussing with Greek authorities was how, with the help of some kind of precautionary arrangements, Greece would return to the financial markets. And now, certainly, it's a good time for countries to return to the financial markets because liquidity is there, interest rates are record lows, so it's certainly a good time. So, and what we see now, that just when Greek economy was turning around, unfortunately, it's now thrown back into financial instability and more likely than not also back into recession. So, really, this was a perfectly avoidable situation. So, nevertheless, so where do we stand now? So, as you know, current Greek bailout program has been extended till end of June. And there was agreement in Eurogroup, so Euro area's finance ministers meeting to have technical negotiations till end of April, and then to see whether there is enough progress to actually successfully complete the program and to disburse the funds within the program. Well, now we are close to the end of April, certainly in the second half of April. So far, progress has not been sufficient. Well, there is still some time. There's also a possibility to continue those discussions in May. But it's clear that liquidity situation of the Greek government is very complicated. So there is a reason to speed up the negotiations and to come to the quick agreements. And that's a scenario what European Commission is working on, to reach agreement within existing program and to successfully complete the program. And certainly European Commission is working based on a scenario that Greece stays in Eurozone. So we are not engaging in all those what-ifs and discussions. We are thinking that there is a possibility to reach agreement. Of course, for that, it's very important that all sides, including Greece, stick with their commitments. So what is now needed is really progress from the Greek side in terms of preparing their structural reforms list and implementing program conditionality.
In the back.
Thank you, Commissioner. I would like to follow up on Professor Royo's question, more from the European legal perspective. We have Article 50 in Treaty European Union, which provides a legal reference in case of exit from the Union. Looking at the situation in Greece further, and I'm teaching a course on Europe here in Harvard and had questions on that, is there a way that a member state out of the Eurozone can be forced to leave? Is there a legal reference somewhere, which I have been trying to find, and if you could enlighten us on that. Thank you.
Short answer is no. What a treaty says that joining the euro is irrevocable. That's all what a treaty says, and I think that's another reason for European Commission not to engage in discussions about all those Grexit scenarios, because as a European Commission, we are clearly working within the limits of EU treaty.
Quick answer. I think you had a Your hands up, yeah.
Thank you. My name is Marianne Muona, and I'm from the Harvard Law School. I'd like to get back to the architecture of the euro and on the theory that it's laid on, going back to the optimum currency area theories of the 1960s, and the idea of Peter Kennan that the currency area is not possible without the fiscal capacity or fiscal budget at the currency level. So I'd like to, and I know that in the past, like when preparing the EMU in the 1970s, the McDougall report also came to the same conclusion. In the 1990s, the Commission of the European Communities published a report where a similar claim was made that a budget or something alternative would be needed to stabilize the regional cyclical differences, plus to help in kind of managing the macroeconomy at broader level at the currency area. So what would be your stance about the proposals that have been thrown in the air in the past years, even of the small fiscal capacities, like amounting to 0.2% of the GDP, like the one of the Paroas Keupa group 3 years ago? That would these kind of even tiny fiscal capacities help alleviate the situation in the Eurozone?
So giving the Commission more fiscal power.
Good. As regards fiscal capacity, it's actually one of the ideas which is already mentioned in several documents. As you know, there had been already some considerations given about deepening of EMU, so-called Four Presidents Report, Blueprint for Deep and Genuine EMU, also for that sake Commission's communication on the social dimension of the EMU, and number of considerations had been given also to the fiscal capacity, also to the so-called Eurobonds, or which are now called Eurobills, and certainly we will return to those discussions. Actually, already in June, we could expect the next or the second Four Presidents report to actually continue develop this ideas of deepening of the EMU. We still would stick with this two-stage approach, one which can be done within existing treaty, and second, with a more longer-term view, what elements may also need a treaty change. And I already mentioned this underlying principle which we'll need to follow is that further steps towards risk sharing or mutualization, which also that kind of fiscal capacity would imply, will help to go hand in hand also with further steps into sovereignty sharing or actually decision making at the European level. And of course, we do not expect this being a very simple, very easy debate, because as it has proven in previous times, that kind of discussions tend to be quite controversial. But from Commission's point of view, we are really willing to take a systemic look on what elements are missing, and to look how we actually can arrive at those elements. And fiscal capacity is very much one of the elements which is being discussed.
Could you talk a little bit about how the dialogue between the European Commission and the European Council, the heads of state in Europe, works? Because as you pointed out, this is not just an issue of kind of economic theory or legality, but it's ultimately a question of politics. Are people in Europe and the European member countries willing to hand more sovereignty to the European level? Where are the discussions on that?
Well, of course, those discussions are primarily taking place in EU Council. Actually, Council had a debate already in February, because it's then primarily, especially if we talk about measures which imply a treaty change for a member state for member states to decide how much deeper member states want to integrate, or what further steps they are willing or able to take. And from the Commission side, of course, we are supporting this process, giving all the necessary expertise which we can to actually facilitate the decision making by the member states. But at the end of the day, the decisions on this will have to be taken by the member states.
Follows up on the last. My name's Andrew Martin. I'm here at the Center for European Studies. Follows up on the last two discussions about fiscal capacity. When your discussion of the growth strategy for stimulating recovery, the word demand was never mentioned, and I think that has particular relevance to the issue of why not more investment. I suppose that the greatest risk that investors have to worry about is whether investments would result in profits. And that in turn could hardly be that risk could hardly be diminished without adequate demand in the economy as a whole. This does raise the question of the role of fiscal policy in stimulating demand. You pointed out that the prospect was for the aggregate stance to be neutral. How can an at the same time, you pointed out, of course, as we know, that there's an enormous divergence in the stance of the member states, enormous divergence in the levels of debt, and the pursuit of fiscal responsibility involves, from the Commission's point of view, from the European point of view, the reduction in debt, which means reduction in primary deficits in the high debt countries. Part of my question is two parts. One is, how do you arrive at a neutral stance when some countries are reducing their deficits by reducing or actually achieving primary surpluses, while at the same time, without at the same time the countries with lowest debt are tolerating higher primary deficits and perhaps growing levels of debt. How do you arrive at a neutral stance, in other words, when the main thrust of fiscal responsibility is the reduction of debt and deficits? That seems to point to a major consequence or cost of the lack of fiscal capacity in the EU, and a major difference between the EU and the US. You mentioned a number of differences, but the difference in fiscal capacity seems to be perhaps the most important. Fiscal stimulus in the US has been limited. Nonetheless, it was an important factor in stimulating the recovery.
So one of the key questions I think that we hear in the US on kind of raising
one part
demand.
of that has to do with access to capital markets. The most important contributing factor to fiscal capacity in the United States as a response to the crisis has been the limitless access to financial markets that the federal government has, so that any lack of access to capital markets on the part of the sub-central units really doesn't matter very much for the aggregate fiscal stance, whereas it matters entirely in Europe for the aggregate fiscal stance.
Okay. First, on this never being mentioned. Actually, I just checked my speech. So, on the demand side, there is a clear reference. So, talking about fiscal policy, so member states with excessive deficits need to continue their adjustment, while those with available fiscal space should use it to stimulate investment and the consumption side of the economy. So it's clearly it's clearly there. And if you look at the mentioned country-specific recommendations, last year's country-specific recommendations, this year we are due to issue in a couple of weeks, then country-specific recommendation to the Germany was exactly this, to use its fiscal space to stimulate the investment and demand side of the economy. So that's exactly part of the thinking. Then on the broadly neutral fiscal stance. Yes, so currently we have a broadly neutral fiscal stance. We are talking now about euro area. And while having this broadly neutral fiscal stance, we expect an average budget deficit in euro area to go down from 2.6% of GDP to 2.2%. And this thanks to the economic growth and not due to the overall additional fiscal adjustment. So, and we think that this broadly neutral fiscal stance is broadly appropriate in current circumstances, especially when combined with accommodative monetary policy. But then I think it's important not to confuse this discussion about member states' fiscal stance and the fiscal capacity, because those are two different things. So first, if we talk about EU budget, and for that sake, there were some questions also on fiscal capacity. So EU budget is less than 1% of EU's GNI. So maybe, roughly speaking, maybe around 1.0% of EU's GDP. So it's not a major budget, and if you mention fiscal capacity of 0.2% of GDP, so it's not what will be a major game changer in terms of fiscal stimulus if we were to consider fiscal stimulus a game changer. So it's still with the member states' budgets, because their member states' budgets are, I don't know, 40% of GDP, 50% of GDP, some have even more. So that's where you can discuss fiscal stimulus if there is a space. But once again, I mentioned that on this we have actually more restrictions than US has, because US can finance its budget deficit, and markets have appetite for this. In EU, markets did not have an appetite to finance EU member states' budget deficits at debt levels which were on average lower than in US. So EU has a public debt of around 90% of GDP, whereas US is already well above 100. And still, EU member states were actually being cut off financial markets. So this is something we need to keep in mind while thinking of our fiscal policy. And that's why EU actually had to do this fiscal adjustment to regain financial stability. Now, certainly we are in much calmer waters, and that's why we are exactly recommending to the member states, if they have a fiscal space, to use it to stimulate the economy.
So it is, I think there's the difference that we don't have a United States of Europe, and I think ultimately the political structure leads countries to make choices that look at their interests, obviously. If I may, I mean, I would also think that we need to look at the multipliers that we hope that will occur. I mean, both in terms of demand stimulus, but I think also now the investment plans kind of hopes that the private sector will be pulled in a big way, and we'll have to see whether those multipliers that we hope for are actually going to materialize. That depends a lot on the decisions of many different atomized individual actors and firms and consumers. So that might be another area to look at. There was another question here in the front row.
Yeah, Bob Rosenberg. So I'm involved in international relations and also in international business. And my question is, I just need a clarification on the trade issue. Is that negotiated at the EU level, Commission, or is it negotiated country by country? Because I think there are negotiations going on between, well, they may be on hold for a little while, but between the US and the EU. And what is that policy? Because it does impact the economy of all the countries within the EU.
Okay, so our international trade negotiations, like TTIP, are negotiated at EU level. So it's Trade Commissioner, now Cecilia Malmström, who is in charge of those negotiations. And if the agreement is reached, then it's ratified by member states and also by European Parliament. So its negotiations itself are done by European Commission, but ratification, so approval of the deal, is then by the member states and by European Parliament. So it's relatively complex decision making.
But of course, it's trade policy and competition policy as one of the policy areas where the Commission actually does have a lot of executive power compared to the other areas like fiscal policy that we talked about.
Well, this is like more trade policy,
Right,
it's less
right.
of competition policy.
Right. No, but competition policy is another area where the Commission has the
that's
same
true.
type of powers. Elaine, please.
Mr. Vice President, thank you very much for being here. I hope you'll excuse me for returning again to the question of Greece, but I can't resist the opportunity to probe you a little bit more. As you mentioned, the position of the European Commission is to keep Greece within the Eurozone. But as you also mentioned, the talks seem to be stalling. The situation seems to be worsening. And Greece seems today to be seizing as much as its private sector funds as possible to try to meet its next payments. Many observers are now starting to talk about the possibility of a Greek default while it remains within the Eurozone, and specifically a default on its payments to the IMF and to the ECB. I wanted to ask if anybody is thinking about this possibility. Is it a possibility? And what sort of preparations might be underway to deal with that as a possible scenario?
Well, on this, once again, I'm hitting my institutional limits, because I already gave this Commission's position on this, that we are clearly working based on a scenario that Greece stays in Euro area, based on a scenario that we finish and successfully conclude current bailout program, and we are not engaging in speculations on what ifs and so so I'm sorry, I will not also engage deeper in all those scenarios which are being massively discussed, because we are concentrating on the scenario which we think is most beneficial for both Greece and the EU as a whole.
We will, in any case, see how this plans out in the next month or so. So one final question.
Thank you. My name is Bart Higgins. I'm just an interested citizen. I'm retired, so I have the luxury to read the European papers every morning on the internet, which is extremely interesting. But I must say, with respect and a little bit of humor, I'm a little bit disappointed in your presentation, in that I was very interested in your role, as is shown in the European press, where you're typically the hard man who is quoted as, after everybody else has their say, oh, and there's Dombrovskis, and he says, and then he tries to argue for the need for structural reform or fiscal responsibility or like that. And so my question is your personal experience of this, and also your sense of the philosophical issues here as opposed to the administrative and structural ones. Do you feel you have any constituency that is listening to you when you're arguing for these things? Because from the papers that I read anyway, it doesn't seem to me that there is. You seem so isolated
in your arguments.
So we need to see which papers you're reading. But
basically, I read all of them.
very heterogeneous in Europe, of course. Mr. Dombrovskis, hard question.
Does the question
to
make sense? Or
answer.
do you feel lonely in a philosophical sense?
Well, on this, I think we had already heard questions, at least on one side of the argument. Of course, you also hear opinions and views on the another side of argument. For example, when European Commission presented our communication on best use of flexibility for within Stability and Growth Pact, we were to the extent criticized about it still not being flexible enough. And in some countries, we were quite harshly criticized, and also by ECB, that actually it's too flexible. So, this where you stand on this argument, it's always relative. You tend to have critics on both sides of this debate. So from that point of view, to answer your question, I'm certainly not feeling lonely. I'm trying to find the right balance between those arguments and to try to find right balance which economically makes sense right now. And there seems to be, I would say, quite a few economists which are, once again, broadly agreeing with this European Commission economic policy priorities as we are having them now.
So maybe that's the spirit that comes into the Commission from the northeastern side of Europe, pragmatism rather than the big solution. I think this was a very wide-ranging discussion. We went in a lot of different issues. I felt almost like you must feel like you're sitting on a hot seat there, but I'm sure even through your experience now, that's something that you've gotten very used to. I do want to ask one very hard question at the end, and sometimes at HBS we talk about a stretch question at the end of our sessions. We did have, and I think picking up a little bit on your sentiment, we had a very good but also somewhat technical discussion of all the different complex issues. As a European, I feel while all these things need to be addressed, what's lacking at the moment seems to be the enthusiasm for the European project. The kind of, well, we're ready to do things because we see this broader vision of an integrated Europe and its role in the world. Is this something that you discuss with your colleagues in the Commission, or is this just not the time and we need to focus on the real very hard questions in Greece and other parts of European policy making that need to be dealt with first?
Well, as I mentioned in a speech, Europe is now coming out of a deep and double deep recession. And indeed, it has been already quite a few years when we were dealing with economic and financial problems. So certainly, mood is not very enthusiastic after this years-long crisis. So, and from that point of view, I think it's important now really to concentrate on economy, to get economy going again, and to actually make sure that this economic recovery is also felt at the people's pockets. And there is always some lag between you start seeing recovery in macroeconomic figures, right, and before people are actually admitting that they are also seeing it in their lives.
Right.
So, and now it's really important to make sure that people are seeing this recovery. They are seeing that European policies can actually help. And then I think we will be able to talk about return of enthusiasm.
Very good. Well, I think a lot of these issues are actually pertinent in the U.S. as well. We've seen a bit of a stronger recovery, but whether the average American has felt so much of that, I think, is widely debated in the press. Vice President Dombrovskis, thank you so much for your questions. And thank you all, and thank you to the Center for European Studies for hosting us today.